Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 11th of October. I'm Daniel Lam, your host for the podcast. During my days at the Hangzhou Asian Games, every player in the Hong Kong-China chess team got into similar routine, i.e., reviewing the game that was played in the afternoon after it ended, take dinner, and then preparing for the opponent for the coming day. So, I look at the last podcast that I did before I went there to prepare for this podcast. And talking about relevance, it was about oil prices. Now, the main point that I highlighted 2 weeks ago was the disruption in supply. For example, the production cut from Saudi Arabia and from Russia. Disruption in supply is likely to be a driver in focus for oil prices going forward, given the conflict in the Middle East. So far, the oil price reaction seems to be rather modest and may have been caused by short covering from some of the more extreme market bears. However, there is potential for the prices to respond further in the form of sanctions on Iran. SCB Global Research pointed out that the 5 main turning points in Iranian oil output since 2010 have all been associated with changes in US policies. Now, year on year, Iran's output is higher by just over 500,000 barrels per day, almost all of which appears to have been exported to China's independent refiners. Now, the US seems to have 3 broad policy options in relation to Iran's oil output. So, the status quo, with output at 3 million barrels per day or higher. The second option is the pre-2023 plateau of close to 2.5 million barrels per day, or 3, near zero exports with output below 2 million barrels per day as reached at the end of the Trump administration. Now, a week ago, option 1 was the most consistent for the US in terms of both market influence and geopolitics. And we believe the key question now is the extent that further developments in the Middle East bring option 2 and 3 back into focus as potential policy targets. Now, in our latest global market outlook, we raised 3-month WTI oil price expectation to $90 per barrel. Now, technically, 90 to 95 is a key resistance zone on the chart, and this zone may be reached if there were to be sanctions on Iranian output. On a 12-month horizon, we expect demand to emerge as a key driving factor. WTI oil prices likely trending lower towards $75 per barrel because we believe that the global crude oil consumption growth year on year is likely to decline due to slowing Euro area and Asia. The risk to this thesis lies in the Chinese economy. Oil demand could improve if the economy undergoes a significant recovery in the fourth quarter this year. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.